with the top management of Hexaware Technologies. Here's our Srikrishna, the Chief Executive Officer. Srikrishna, always a pleasure chatting with you. Thanks so much for joining us. The quarter, that's Q4, is usually seasonally soft, but it was turned out to be a good one. But this is disappointment, the margin and forex loss hitting the bottom line far more than what the street was expecting. Why was that the case? What did you have to compromise on?
I would describe the revenue performance not as satisfactory but awesome. Okay, if you just look at our Q4 numbers historically, it's hard to deliver 3.4% constant currency growth because we have headwinds. We have furloughs. It's a low calendar. People are cutting budget at the end of the year. All kinds of headwinds. Notwithstanding that, we delivered 3.4% growth on the back of solid volume growth. So actually we feel very good, but it also sets us up nicely with a lower CQGR ask for our FY19. The second kind of most important takeaway is that apart from the revenue performance in Q4, we also had our best quarter ever for new deal booking. We had our first $100 million new client, and it's never happened in our history before. So it's actually, we feel very good because it sets us up quite nicely for FY19. From a margin perspective, a Q3 to Q4 drop is absolutely planned. It happens every year. It happens every year due to two big sets of reasons. Calendar and furlough, which I spoke about revenue front, it also affects our margins. In fact, it has an outsized impact on margins because our costs don't quite go down the same way that revenues do. It's also our salary increment cycle. We have a little bit in Q3, but the vast majority of our salary increments happen in Q4.
You just highlighted the strongest order book for new clients in the fourth quarter. The biggest client win is in the $100 million category. Such a strong exit to 2018. How do you see this kind of a run rate being sustainable going ahead when there are so many global uncertainties? Brexit, the forex movement, the trade war. How do you navigate through all of these uncertain times?
So on the, what do we expect in terms of order wins? It's of course early in the year, but what we've been doing for a number of years is to grow the deal wins every single year. So last year we did 170 odd from new clients. This year it's in excess of 210 from new clients. The previous year it was, I can't remember, 140 or something. And so we've been growing it consistently, and we expect that trend to continue. In terms of macros, Brexit is of course a big variable, but I think frankly at this point, no matter which side it swings, we think it's going to actually create some pent-up demand. There's a lot of kind of plans on hold, right? Do I need to invest here or there? And neither has happened because nobody knows which way it's going to swing. I think once there is a clarity, which will hopefully come in the next 2-3 weeks or few weeks, we think actually some investment will get unleashed because it's been pent up. From a U.S. perspective, I think kind of a little bit slowdown from a great economy is not like bad news. I think that's different from a marked slowdown, which we are not seeing. There may be, a couple of percentage, couple of points, 0.2, 0.3% slowdown, if at all. But that is still pretty robust.
You're guiding for a 12 to 14% organic growth in 2019. What is the scope of margin improvement from the current level, considering the demand situation and US is expected to grow?
So there are three different questions there. US expected to grow at about company average or slightly below, and Europe and Asia will grow faster. In terms of currency impact, we've not assumed a change. We've not assumed a rupee depreciation or appreciation. So what I said in terms of, same full year EBITDA in 19 as the full year EBITDA in 18, which means a step up from the Q4 levels, that does not assume a currency depreciation. If it does, it could aid margins. I spoke earlier about the fact that there is a tight labor situation in the U.S. and we've accounted for it. We've paid a higher than usual increment in Q4. And we expect to see a tight labor market which will require and necessitate investments in skill creation, which is what we're doing. We're doing skill creation in the U.S., we're doing skill creation in neighboring Mexico, and we think that's kind of going to be the biggest headwind, if you will, to margins. Operating leverage is a great tailwind for us. Clearly that growth will give us some operating leverage, but we also continue to make investments in sales and marketing.
According to reports, Baring, which owns majority stake in your company, is looking to pick up a preferred stake in Hexaware Tech. Are you open for such proposal in terms of Hexaware? Can you clarify on these talks?
I mean, two things. I think if everything media reported about Baring and Hexaware were true, would have been sold about 7 times in the last 3 years. Clearly, that's not happened, right? The second thing is, I think, if whether Baring is investing in NIT or not, I don't know. It's a question for Baring.
Thanks so much, sir, for taking out time for us explaining about the numbers. Hexaware confident of growth, and 12 to 14% is the guidance.